In 2008, the global financial system came to the brink of collapse, leading to widespread job losses, reduced consumer confidence, and a sharp drop in economic growth. But what exactly happened during the financial crisis of 2008? Make sure you subscribe and turn on the bell notification so that you'll never miss another video again. The financial crisis was caused by several factors, including the subprime mortgage crisis, overleveraging by banks and financial institutions, and a lack of regulation in the mortgage and financial markets. The crisis reached its peak in 2008 when a significant number of homeowners began defaulting on their mortgage payments, causing the value of mortgage-backed securities to drop. This led to huge losses for financial institutions that held these securities, and several large financial institutions faced bankruptcy. The financial crash of 2008 had a profound impact on the global economy, causing widespread job losses and a sharp drop in consumer confidence. The U.S. government intervened by bailing out several banks and providing support to the financial system, but the crisis had far-reaching consequences, with many countries around the world also experiencing major economic problems. The crisis had a profound impact on the developing world, with many emerging economies facing a sharp drop in economic growth, reduced investment, and increased poverty. For example, countries like Mexico, Brazil, and South Africa, which were heavily dependent on exports to the developed world, saw a sharp drop in demand for their goods and services, leading to a slowdown in their economies. This highlights the interconnectedness of the global economy and the far-reaching impact of financial crises, even on countries that may not have directly contributed to the crisis. It also underscores the importance of global cooperation and coordination in addressing financial crises to minimize their impact on the global economy and ensure sustainable growth and development for all countries. The crisis was not just limited to the U.S. The financial crisis had a global impact, with several countries, including the UK, Ireland, and Iceland, also facing major economic problems. The crisis was not caused by a single event. While the subprime mortgage crisis was a major trigger, there were several other factors that contributed to the crisis, including the lack of regulation, the over-leveraging of financial institutions, and the failure of risk management systems. The crisis affected people from all walks of life. The crisis was not just limited to the financial sector. It had a widespread impact on the global economy, leading to job losses, reduced consumer confidence, and a drop in economic growth. The response was a global effort. The response to the crisis was not just limited to individual countries. It required coordinated action by governments and central banks around the world to prevent a complete meltdown of the financial system. The crisis led to significant reforms in the financial sector. The crisis resulted in significant changes to the financial regulatory environment, with new rules and regulations aimed at preventing similar crises from happening in the future. These are some of the lesser-known facts about the 2008 financial crisis, which highlights the complex and far-reaching impact of the event on the global economy. Global impact. The financial crisis of 2008 was a global event, affecting economies all over the world, including Europe and Asia. Stock market decline. The crisis led to a significant decline in stock markets, with the Dow Jones Industrial Average dropping by over 50% from its 2007 peak. Unemployment. The recession caused by the financial crisis led to a rise in unemployment, with millions of people losing their jobs. Government bailouts. Many countries, including the US and UK, had to bail out their banks to prevent a complete collapse of the financial system. Foreclosure crisis. The subprime mortgage crisis led to a large number of foreclosures as people were unable to keep up with their mortgage payments. Reduced lending. Banks became more cautious in their lending practices, reducing the availability of credit and slowing down the economy. Changes in regulation. The crisis led to significant changes in regulation, with governments around the world introducing stricter rules for the financial sector to prevent a similar event from happening in the future. Long-term effects. The crisis had long-term effects on the global economy, leading to a slow recovery and a continued sluggish growth in some countries. Subprime mortgages. A high number of people were given home loans they couldn't afford, known as subprime mortgages. These loans had a higher risk of default. Complex financial products. Investment banks packaged these subprime mortgages into complex financial products known as mortgage-backed securities and sold them to investors. Overvaluation of housing market. The housing market was overvalued, and when people started defaulting on their mortgages, the value of these securities plummeted, causing large losses for banks and investors. Lack of regulation. The lack of government oversight allowed banks to take excessive risks, further exacerbating the problem. Interconnectedness of financial institutions. The interconnectedness of the financial system meant that the failure of one institution could quickly spread to others, leading to a crisis of confidence in the markets. As a result, several major financial institutions failed, including investment bank Lehman Brothers, and the U.S. government had to intervene with a $700 billion bailout to stabilize the financial system. This had a ripple effect on the global economy and resulted in a recession that lasted from 2008 to 2009. The response to the crisis was a global effort, with governments and central banks around the world taking coordinated action to prevent a complete meltdown of the financial system. The crisis also led to significant changes in the financial regulatory environment, with new rules and regulations aimed at preventing similar crises from happening in the future. Brief overview of the 2008 financial crash and its impact on the global economy. But if you think that was crazy, wait until you hear about the time the global economy shrunk by 15% and worldwide industrial production declined by 37%. Wait? You didn't know about that? Well, click here and find out why.